Hi everyone, welcome to YX Insights. This is Yimin. This is our first market update for 2025. We're going to go through some of the details around the non-farm payrolls, as well as the latest development in Fed liquidity. We're going to look at how yields have done in terms of FOMC projections. And then we're going to move on to live market updates on SPY, QQQ, IWM, as well as gold and silver. So let's get started. So Friday's data came out very strong for US non-farm payrolls in December, 256,000 net new jobs added, which brought down the unemployment rate to 4.1%. So this is actually slightly above our initial expectation, my initial expectation, because the initial claims data actually ticked up in December. But there's a lot of month-end hiring for seasonal jobs like Christmas, and there has been applied a seasonal adjustment factor to the non-farm payrolls data. But in this year, the seasonal adjustment factor was actually significantly higher than 2023, which meant if you apply the same seasonal adjustment factor to the same factor to 2024 data, you would actually get 167K net new jobs added, which is actually in line with the consensus. So there's a little bit of a data massaging going on in the release of the non-farm payrolls. For what reason, of course, I don't know. But I think that is just a little bit of a caveat for looking at this data. But whether it's 167K or 256K, that is still a very strong labor market, especially if you're looking at just the official data. We have 300K plus new new jobs added in the past 4 months. That signals we're quite far away from recession, at least for now. So overall, the Fed shouldn't be concerned about the labor market right now. Of course, it's softening, but it's not deteriorating so fast like we had in August, which caused a 50 basis point cut in September. So actually, since September, most of the data have surprised to the upside, except for the hurricane season here in October, which gives the Fed comfort to refocus on fighting inflation again. Hourly earnings also dropped slightly to 3.9%. Overall, I would say, 3.9%, 4% hourly earnings is still quite high, but at least this reduces some of the pressure from the labor market on core CPI. And especially around the non-housing services CPI. Historically speaking, average hourly earnings and core CPI have a strong correlation. So now the market has essentially priced away the second cut for 2025. We are expecting really just one cut in 2025. I think Bank of America even said that the next move should be a hike. So overall, the market is quite pessimistic around future cuts. And as you can see, the curve is actually really well spread out. The market isn't really sure when the next cut will be, just spreading the 5 basis points across 6 meetings. What this really means is that when we're going to get the next cut really depends on when the next set of CPI or PCE that shows significant improvement towards the inflation target. And actually, for this year, the Fed pins a projection of 2.5% PCE for the year end, because some of the members are really concerned about tariffs and potentially tax cuts effects on inflation. So the market is really expecting high inflation field rate cuts for this year. In terms of the Fed balance sheet and the Fed liquidity, we have seen an uptick in the overall Fed liquidity in the past week after the year end. So during the year end, there was a sharp spike in the reverse repo levels as because there has been a greater funding needs for the year end. The year end effect has now gone away, and we have seen a loosening of Fed liquidity, which means the RRP levels has dropped back down. And also because of the debt ceiling issues, the Treasury cannot issue new debt, which means they're going to have to run down the Treasury general account. And generally speaking, that is better for liquidity. That's more money entering the economy and also the money market. So I think this should start to provide a near-term support. I don't mean it will rally 5% in SPY tomorrow, but in the near term, we should find a local bottom for stocks. And similarly, the worsening of this Fed liquidity, which means the red line going down, makes yields go high, but it pressures the yields go higher because the funding costs start to rise. However, the improvement of the Fed liquidity we have seen recently should help bring the yields back down a little bit. And that helps me find a slight comfort that we might find a near local top in the 10-year Treasury yield. And that should help stocks pick back up. Why? Because the 10-year Treasury yield and the SPY and QQQ are negatively correlated right now. So if we get the 10-year yield down, we should get the stock market moving back up again. So we need to find a local top for the 10-year yield and then the local bottoms for QQQ and SPY. And in the very long term speaking, and this is from a valuation perspective, it doesn't mean the market will crash tomorrow or next week. What this means, we are trading at around 29 times PE for SPY, so the S&P 500. And historically speaking, when we're entering this zone, the next 10-year returns are going to be quite tough. I think the investors have been spoiled by the consecutive double-digit rises in SPY and feel like we don't need to get any defensive with bonds, and bonds have been in a 4-year bear market. So people are really ditching the buffer that is being provided by bonds and just really chasing returns in stocks. But as we enter this high 20s and even low 30s territory, we risk significantly underperforming, losing capital in the next 10 years overall, versus if we entered at below 20 times PE. So the market valuation is getting stretched. My expectation is we're going to move higher in the near term, but we can see a significant decline in the medium term. And that will bring the long-term average returns down to around below the 3-5% level that we see historically speaking. And this is just a visualization of where historically the market has traded in the next 10 years in terms of compounded annual returns versus the multiple that you enter the market with. So at 29 times multiple, sub 5% returns. And of course, you get odd years where you have 10 double-digit returns, and you have years where you have negative returns. But overall, we're looking at a sub 5 return per annum in the next 10 years. So this is entirely based on historical performance. So now let's move on to the live market update. SPY, my expectation is we will get this final leg lower capitulation in the near term, just below the 570 level. And that would be the completion of wave C. And actually, I had this marked out over here as this really looked like a B wave bounce. And I did expect this C wave to come. What is the catalyst? As I mentioned earlier, the catalyst for this bottom building is really for the 10-year yield to find a local top with the negative, as it is negatively correlated with stocks right now, and then SPY should find a local bottom here. Potentially CPI on Wednesday. The non-farm payrolls show that average hourly earnings dropped lower last month, which should help reduce some pressure on the core CPI. Similarly, for QQQ, I expect a final leg capitulation to happen in the near term and bring us down to 500 or below level. And then that should give us a local bottom here. IWM has been trickier than I expected. I did think that we could have bottomed here in the near term, but it doesn't seem to be the case. So I'm slightly neutral now. So I have re-examined the chart, and I think we are heading towards this wave three, generally speaking. But again, we need to find a local bottom around here soon. So hopefully IWM can rally with SPY and QQQ. It had the worst December, one of the worst Decembers on record, 8% drop. And with yields moving lower, it should give growth stocks, small caps, a bit more breathing space to find room. I do expect IWM to make a new high, and it has disappointed recently, but in the medium term, I do think we can get above 250 and then towards 300. So TLT has been very bearish recently, mainly because of three reasons. First, we have had rising inflation expectations from Trump's potential tariff plans. That has reduced the FOMC's dot plot and the expectation of cuts for 2025. Secondly, oil prices have gone up as well since December, which have further pushed up yields in the longer end bonds. And thirdly, there has been a rising term premium in the longer end bonds as well. And in December, the 10-year term premium rose by 40 basis points, which is quite a big jump from where it was before. So, and that is more to do with uncertainties around the fiscal disciplines in the new administration. And I do think fundamentally the market is front-running the policies a lot. And what I mean is that Trump has not yet announced what the tariffs plan will be. And US-China trade deficit has shrunk dramatically since 2018. And I think for 2025, the concern for oil is the shrinking China demand and a potential increased supply from OPEC plus, which they had been delayed until April, but after April, they could bring more barrels to the supply. So I think all of this makes me just a bit cautious in chasing yields here. And I do think this October 2023 low is quite a key level to hold. Breaking this low could prove that my thesis is wrong or the momentum is just way too strong to stand in the way. So, and 30-year could actually trouble to 6%, and we're going to have hikes next, as the Bank of America analysts expected. So I am just cautious here. We stopped out in our stop loss with a stop loss at 87 level, but right now we don't have immediate signs of bottoming yet. We could travel, of course, down to 83. I'm just trying to be cautious and look for signs of reversal first. We could potentially get that with the CPI this week because Nonfarm Payrolls showed a slowing hourly wages in December, and that could reduce the pressure for core inflation. But I'm not rushing to build a new position in TLT just yet before there's a bit clarity around this bottom process as well as potentially Trump's policies. Next up, gold. I think there have been a mix of factors influencing gold right now. So the big one is global liquidity level. The gold lags the global M2 levels by about 3 to 4 weeks. So we saw there has been a bounce in November, but the global liquidity levels have still experienced headwinds from a stronger dollar in the past month. So that makes me a bit cautious about going long on GLD here. And what is more likely is that this rally was a B wave, and we're gonna get the C wave down now. And this is one to set up to the downside. The good news is that China has restarted buying. They restarted buying gold in November and continue to buy in December. So the EM central banks are coming back to the market, and they are pushing towards de-dollarization. So from the central bank's perspective, in the longer term, I still think gold is bullish. We still have an all-time high to break, and we will get above that. But just in the short term, the global liquidity level, and also a lack of interest from ETF flows in US and Europe could just push gold down for the final capitulation. And then we're going to build back up for the wave 5. Similarly, in silver, silver is a bit more volatile. To me, this looks like a B wave here. And I think we could rally a little bit because it follows gold. There's a bit of a time lag. But overall, I do expect we get below 25 for this final C wave. So gold and silver are still cautious right now. And we will just look for the signs of bottoming before entering a new trade. So this is for today. I am going to write a new update on oil as well as China